I want to get right to our program. We're very excited for our first keynote of the day. I'd like to introduce, so before I introduce, what we wanted to do with our event this year is that we wanted to kind of do a little toe dip into some sectors that as a generalist conference we haven't necessarily covered as extensively, that I think really should get some more coverage and really just more awareness. So with that, I'd like to introduce our first keynote. It is Tavi Costa, the portfolio manager at Crescat Capital. And with that, Tavi, take it away, man.
I would like to thank Bobby and Jessica for the invite and the SNN Network as well. We run a global macro hedge fund and long-short strategy, and also a precious metals and base metals focus fund. There's a lot going on in the markets today, and I think this is probably one of the most opportunistic times that I've seen in at least my career. And I think we're facing some profound changes in the global economy now that are likely to unleash a plethora of macro early stage secular trends that are macro forces. Some of those are structural changes powered by easy money policies and debt to GDP at record levels right now. But this is the first time in 120 years that we've had what I call a trifecta of macro imbalances. We have the debt to GDP problem of the 1940s, we have the inflation problem of the 70s, and we have the speculative environment of the late 90s and the late 20s. Policymakers have become their own prisoners in this environment, and I feel strongly that those extreme imbalances create true political constraints when it comes to fighting things like inflation. How can we stop cost of capital from rising and put a lid on inflation at the same time? I think this is the biggest question policymakers are facing. Whether the Fed tightens financial conditions or do the opposite, both should probably have a negative impact in the markets, my personal opinion. I think we have four pillars of inflation today that are very important to point out. One is the wages and salaries growth. This is very similar to what we saw back in the 70s, just looking at the data. I think we're at the early stages of that. Number two is the commodities and I would say supply constraints that I'm going to touch with a lot more details in a second. Number three is the reckless fiscal spending. This is the most aggressive, or one of the most aggressive fiscal policies we've seen in history at a time when unemployment rate is basically at a record lows and at a time when inflation is at one of the worst levels we've seen in 50 years. And the fourth one is deglobalization trends. We got wars breaking out. We've got US and China issues escalating. And the third one has to do with the excessive leverage, which usually, historically, we see wars leading to that. As we enter an inflationary regime, which I believe we are, I think it's important to go back in history and see what happened during those times. We've had really two times when median CPI, which may not be the perfect way to gauge inflation, but let's use that just for an example and a way to statistically look back in history. When CPI was above 6% per decade on a median basis. This was in the 1910s and 1970s. The 1910s with the World War I, you got the pandemic issues at the end of it. We saw the shortage of raw materials coming out of that. We also saw the cost of living rising. And as a result, 1 out of 5 workers at that time was engaged in a labor strike. I think we could see that today. In the 70s, we had 3 waves of inflation. It started really in the end of the 60s all the way to the late 70s. They got progressively higher over time. We had low debt. We had low equity valuations. And so allowed the Fed to have a lot of flexibility when it comes to their policies. I think that one of the most important ones, well, even the 40s too, I should point out, was more of sporadic inflation rates. We had high debt to GDP. And the policy was much more, the tax policy was much more aggressive than today. We look at the high tax bracket, for instance, was almost double to what it is today. But 2 common macro forces played out at those inflationary times. One, real rates were deeply negative at those periods. And tangible assets actually outperform equities. I think we're going to see that. In my opinion, the commodities to equity ratio at 50-year lows is probably one of the best portfolio positionings for the future here. I think one of the biggest fallacies in markets is that equity markets tend to perform well during inflationary environments. That is certainly not what we saw back in the 1910s and 1970s. In nominal terms, equity markets are flat. In real terms, they're actually negative in returns. S&P 500 had a pullback recently. It's down about 13%. But U.S. market cap to GDP is still, 15% above what it was at the peak of the tech bubble. We also see a 5-year cyclically adjusted earnings yield. So just take the CAPE ratio, invert it, and shortened by 5 years. And you can see we're about 2.8% yield. This is lower than it was in peak of 1929, lower than peak of 1937 in the tech bubble as well. The subsequent 3-year average performance was about a decline of 53%. I'm not claiming we're going to see that, but I'm just putting out some of the issues so far. Funny enough, the Dow Jones as well, in gold terms, is just as expensive as it was at the peak of the 1929. So what triggers a problem? I think that's an important question. Is it valuations? I don't think so. It's the rising cost of capital. I think one of the biggest debates for that is a debate in the macro world, which is, are we seeing a structural or a cyclical inflationary problem? In my opinion, we have a tendency of fighting the less war. And so we like to think that we're going to see something like we saw back in 2000 and 2008 when we saw a deflationary shock with equities collapsing and treasuries rallying. But correlations change according to the changes in the macro regimes. And I think we're onto one of those. We're seeing declining growth. We saw declining growth in wages and salaries over the last 30 years. We saw disinflationary forces caused by big technological changes. We saw a very globalized world. And we saw declining interest rates at the same time. So now, 10-year yields are breaking out from a major 40-year resistance. And the question is that sustainable? I do think we're going to see higher yields. So let's focus a little bit. I think the majority of people focus on the demand side of the Treasury market, when I think that the issue is on the supply side. The supply side, we're seeing about $840 billion of issuances of Treasuries today. The Fed used to purchase about 50% of that. It's not buying it anymore, and it's talking about selling it. Number two, we're seeing banks, which were the second largest buyers of those Treasuries, now buying the lowest amounts that they've purchased in the last month or so. And the foreign holders of Treasuries are also been declining for some time now. And I think that we should accelerate with the geopolitical issues. I think we have also the most extensive fiscal agenda we've seen in history by far. We've got the green agenda, which some battery metal companies here may benefit tremendously from that. We have the peak inequality problem, which brings up the bottom 50%, brings down the top parts of the society in terms financially speaking, like it or not. Defense spending today is at a historical low. I think we're going to see higher. We're at 3.3% of GDP. I think we're going to see at least a 6 or a double from here, and that should also drive government spending. The fourth one has to do with the deglobalization trends, which drives infrastructure of manufacturing back to the U.S. In my opinion, back in the 70s, we used to have manufacturing be part of 30% of GDP. Today is at about 10%. I think we're going to see something back to that, which is going to drive non-residential construction in the U.S. and other developed economies. Twin deficits right now, relative to GDP, are lower than they were back at the worst levels of the global financial crisis. That is just calculating current account plus fiscal deficit relative to GDP. So ultimately, I think the Fed is going to be forced to engage on some sort of yield curve control. And my concern is that suppressing interest rates will cause tangible assets to surge even further. See as an example, especially monetary metals. See as an example what's happening in Japan. The BOJ, or the Bank of Japan, the central bank, has announced they're going to be doing unlimited purchases of Japanese bonds. And we've seen gold in Japanese yen terms screaming higher, now close to all-time highs. So we're basically at a race to the bottom for fiat currencies. And when you look at global central banks, if there's a trend, I think we're going to see the need for improvements of international reserves. It's insane to me that we've seen the most credible central banks in the world today actually be credible because they own treasuries, or from one of the most indebted economies in the world. So we went from owning gold in the 70s, earlier before the 70s, to now owning debt from another indebted economy. Think about that. The other issue that I think it's even more important when it comes to the question of is inflation a long-term problem, I think it comes to the chronic underinvestments in natural resources. It's not just a pessimistic view about the markets. I actually think there's a lot of interesting themes to capitalize on, and one of them is on commodities. From many fronts, I think two things should be really stressed here. One is the political and social pressure to go green. We've all seen that from electrification trends and so forth. The second one has to do with the extreme conservatism by commodity producers. They both might be related, and they probably are related, but the sustainability of a commodities bull market is predicated on the spending trends for natural resource industries. It has always been like that, but those take time to reverse. So when adjusted for GDP today, aggregate CapEx for commodity producers is at a 20-year low. Cyclically, just looking at the fundamentals now, when you see how much they're generating in free cash flow compared to other times in history, they're generating somewhere close to 3 times what they used to in the prior peak. If we just look at what their estimates are for 2022, that should be about 5-fold from those times. 30% of their cash flow that they've been generating went to dividends and buybacks. So they're trying to attract shareholders. In fact, the aggregate dividends and buybacks is almost as high as a CapEx right now for those companies. So they're giving money, capital back to the shareholders in a larger number almost than how much they're spending in their own businesses. Again, think about that. Global equity markets today is about $120 trillion, give it or take. Natural resources are about $10 trillion. If you exclude energy, it's only about $3 trillion. So for every dollar that is coming into the global equity markets, only about 8 cents is going to commodity producers. In my opinion, we've forgotten the basic necessities of running a global economy. Most of the capital has been going to technology. Apple, for instance, is about 40% higher market cap than the entire energy sector in the US. And you may say, well, Apple makes more money. That's not true. Energy companies make about 50% higher free cash flow in aggregate relative to Apple. US oil production today is about 11% lower than it was pre-COVID times. GDP is about 9% higher. This is not '08. I don't think this is '08 at all. If it was, CapEx for energy companies would be at a peak. We're at the opposite side of that. E&P companies, exploration and production companies, used to spend somewhere close to $150 billion in aggregate in the US on CapEx. Today, they're spending less than 50. So commodities are all interconnected. You have lumber prices, natural gas prices rising, you have oil, you got zinc, you got ammonia, then you drive agricultural commodities. It's a real domino effect. And we own a large percentage of basket of commodities as a whole. But the one that really amazes me is the precious metal side. It's the most robust balance sheets that I've seen right now. It's the ones that has the best operating margins, most unloved, and uncrowded, in my opinion. Remember in 1973-74, equities collapse, bonds collapse, miners went up 5-fold at that time, in the middle of a collapse in equity markets and a downturn in the economy. So what's the bull case for commodities, for miners in general? We have one of the largest gold prices divergence relative to CapEx. Note that. The other one has to do with the free cash flow yield, which is the best in 30 years. 73% of the miners today are actually profitable. on a free cash flow basis for the first time in the last 30 years. We have the lowest aggregate debt issuances in history as well. One of the lowest net equity issuances in history. In other words, a very low equity dilution. Cash balances are improving drastically. Debt to GDP or debt to assets for the miners relative to S&P 500 sectors like utilities, consumer discretionary, staples, it's actually much better, much healthier. This is setting the stage for one of the biggest M&A cycles I think we're going to see in history. Why? Extreme conservatism. Declining trends on CapEx also cause a declining trend of exploration budget. And so we're seeing a lack of gold and silver discoveries and even base metals to a degree we haven't seen in the past. So some of the majors are facing a supply cliff. And in my opinion, this is the best time to be owning high-quality exploration assets. And that's why it excites me to come to a conference like this. Full disclosure, we own Reina Silver, which is in this conference as well. We have a lot of geographic focus, and I think there's a lot of asymmetry in this trade. Apple's market cap is about 4 times the entire industry of precious metals. And that's not, no, the majority of that money or the market cap is coming from the top companies, not from the lower ones. So ask yourself one fundamental question. When was the last time a major producer of precious metals or base metals developed a large producing mine? Not in a very long time. If there was ever a time to take the risk or the exploration risk to allocate capital in this industry, I think that time is today. So I want to lay out in my last 5 minutes what are those that plethora of macro trends and ways to capitalize in the markets today. I'll give you 14. Hopefully I have the time here. Governments and central banks will be seeking high-quality international reserves. I think gold's going to play a major role into this. Tangible assets to regain a relevance in crowded 60-40 portfolios as an inflationary hedge. I think that's going to happen. Central banks to ultimately be forced to cap long-term yields as we see inflationary problems happening. And I think that's going to create a surge to commodity prices and other tangible assets too. The beginning of a commodity cycle after a chronic period of underinvestments in the industry, in these industries. A new exploration age for commodities as a result or as a way to address the supply cliff. Deglobalization trends that prompt long overdue manufacturing rebuild. I think some construction companies may actually benefit tremendously in the next years as we see that money unleashing in parts of those industries. Rising geopolitical tensions, which tend to spur increase in defense spending. So we may see some defense companies actually perform very well given the amount of capital that's going to be unlocked through government spending, and NATO countries also spending the same into those defense companies. The rise of global interest rates due to the flood of issuances of sovereign debt and the persistent inflation. I think that's a theme as well. Overall, corporate margins, I think, are going to be squeezed. The rising cost of capital, commodity prices, and wages and salaries. I'm very focused on finding ways of being long commodities and short equities. And I want to find which ones are those companies that are going to be hurt the most from that. The resurgence of fundamental analysis and the value investing principles of as profitability comes back. I think as cost of capital rises, folks start really paying attention to the issue of making money. It's something we haven't really focused for many, many decades. A significant shift in market leadership. I think technology is going to suffer as a result of natural resources gaining more relevance in the following years. In geopolitically neutral and commodity-driven economies that may actually gain relevance in this global stage. I think Brazil might actually perform very well. Some other parts of the world, I don't know. Especially the upcoming, that's my last one, upcoming challenges for historically indebted net importers of commodities. I think China is not in a way that will actually perform well in this environment. So I think that gives you some ideas of how we're positioned in our portfolios, but mostly we're looking for ways, asymmetric ways of being long commodities and being short very overvalued assets and the ones that are going to be hurt by margin squeezes. This is not the end of the world. This is just changes in correlations and what we think it's going to happen in the next 5 to 10 years. I'll open up for maybe a question if somebody has one.
Hi, nice presentation. How do you think about crypto in regards to your whole macro thoughts? Thanks.
I think crypto is one of the perhaps the biggest libertarian movement we've seen in history. It has really shifted the way folks have really questioned the credibility of fiat currencies and the lack of a tangible asset as an anchor. And I think that is one of the reasons why central banks will be forced to really reestablish that credibility somehow by improving their quality of their international reserves. So I think some countries may buy Bitcoin, sure, or other crypto assets in order to restore the credibility. It might play a role into that. But I think historically gold plays a bigger role. Crypto is here to stay. I think Paul Tudor Jones said today, and I agree, intellectual capital is certainly chasing crypto markets in a large way. Younger and smart guys are all going to those industries. That's going to have a positive impact. It's just I find it hard to look for inefficiencies in a market that is crowded. It amazes me how, for instance, let's call it most of the exploration assets, when they put out results, the market doesn't even know how to interpret that today. So it's just a way of proving how those inefficiencies are perhaps very good ways to capitalize.
We all know that the dollar and gold could go up at the same time. However, the strong dollar has been somewhat of a headwind for the price of gold. At what point do you feel that the dollar could be so strong that the foreign central banks could pressure the Fed to bring down the dollar by going back to a loose dollar policy due to the fact of being worried about the exports, especially of our wheat, to third world countries?
Having a portfolio that you carry a lot of inflationary assets, it's important to think about what's the other side of that trade. And I think that's the deflationary shock caused by the rise of the dollar. We're long the dollar relative to the Chinese yuan, and we're long the dollar relative to the Hong Kong dollar. Those are two, I think, interesting ideas. To answer your question, I think first we need to see yields, long-term yields, rise further before the market in general, or I should say the Federal Reserve, to start reacting. When are we going to see that? I think the Fed is going to be very vocal when it comes to yield curve control or anything like that. When I hear that, we're going to cover our shorts in Treasuries. But I don't think we're seeing that just yet. And I think that's going to have a result in the dollar too. Personally, I mean, I do think the dollar is the least dirty shirt out there. And I do think gold is going to rise relative to almost every currency in the world in the next 5 to 10 years. But that, again, that doesn't mean the end of the world. I'm quite worried about how, especially when it comes to the Treasury issuance, I mean, no one is talking about this. That amazes me. And I think that's also creating some of the liquidity to the dollar more recently when it comes to the strength of yields actually rising and creating a strength of the dollar recently too. So I don't know, but I think we're going to hear the Federal Reserve to be very vocal when it's time to be doing yield curve control, which should create that second lag of gold prices, where we see gold prices really surge from here. It's my opinion. I've been accumulating assets in the space. I don't know when it's going to happen, but I think it's an incredible time to be doing that.
Do you have time for one more?
Yeah.
Quickly, you mentioned the opportunity into exploration companies with precious metals in particular. There's a lot of them out there, so for people looking, what's some of the most important criteria you use to discern good investment opportunities?
First, I should say, full disclosure that I'm not a geologist, and who does that is Quentin Henney. He's one of the partners of Crescat. Well, look, I think there are a lot of things that are important. One of the biggest fallacies in the industry is to own very large, low-grade deposits that have a lot of leverage to gold prices or silver prices or any mineral you're talking about. We've been very focused on finding really high-grade, economically viable deposits in general. I think we do a great job educating folks in our videos on Fridays every week, explaining how we try to look at that. The other thing that we really focus on is this M&A cycle, is looking for opportunities that have either the proximity to major companies or the kind of profile of a project that can be purchased by some of those large businesses. I mean, that there's different ways. I mean, we've been trying to use quantifying some of those measurements. I think it's one of the most important things is to be in assets that you know that the technical team is capable of doing it. That's a subjective way of measuring. There's certainly a lot of winners out there you should be partnering with. However, it's a little bit of subjective view about it that deserves, it requires I think a geologic expert to be able to discern those opportunities. I've been, very. I think there's also the need for geographic exposure and very focused in places that you think will be unlocking value when it comes to finding minerals. I think there are great places out there. Golden Triangle has been one of them. Newfoundland has been another one of those. Nevada is a great one too. We've found places in Bolivia as well to be heavily invested, even Brazil and Finland, Australia. So, I mean, hopefully I answer your question, but it's a long process of looking at a lot of different factors, a lot of moving parts. And it's interesting. A company will trade at its peak speculation level by about 20% of the value of the mineral in the ground. So that's something we calculated over the years. It's quite interesting how that works. And so that gives you a sense of when to get out of your trade or your investment when you think that you have reached somewhere close to that peak level of speculation. Thank you.